Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 3rd of November 2019 and we're discussing bonds and why negative yields are not as disastrous as some may believe them to be, and why gold and silver will eventually benefit from those bond investors. We spent a long weekend break at a beautiful place called Llangoed Hall, and we are using pictures to accompany today's podcast. So let's investigate. We have, over the past couple of months, discussed gold and silver as growing in attraction to investment advisors and fund managers as a potential alternative to bonds. Now, we have stated that the reason being is that bond yields have fallen considerably, and also in many cases there is a growing number of negative yielding bonds, especially treasuries. Not US treasuries, but other countries' treasuries, who currently have 0% interest rates or even less. There are even corporate bonds, albeit blue chip, yielding negative rates too. So why should anyone be interested in buying them in the first place? It does not seem to make sense. So what we're going to do today is hopefully explain why bonds are still looked for, despite having negative yields, and why this is still a threat to some degree to gold and silver. To the ordinary man or woman in the street such as us, to buy an investment today, knowing full well that it will be worth less when you come to redeem it, appears to be sheer madness. Yes, most people have bought investments that have gone down in value, but they rarely bought them expecting them to do so. So with nearly $15 trillion worth of negative yielding bonds in circulation, this, on the face of it, appears to be unbelievable. Are professional investors truly that stupid? Well, not necessarily. First of all, there are certain funds, often pension funds, that are committed to buying government treasuries as part of their overall portfolio mix, as they are deemed to be safe investments. Yes, on redemption they will give you less than you put in, but they have the backing of the government, and you know in advance what your loss will be, whereas you could buy equities, and the market could crash by 50%. So a small but safe loss is better than a high-risk gamble type environment, and is not so devastating while inflation is relatively low. But we're not going to focus on that here, as there are a number of other reasons why bonds are bought. What we want to concentrate on is that just because the yield is negative, this does not mean you will necessarily lose money. Let us explain. Firstly, the downside. We shall take a look at insurance companies and banks, who are major investors in bonds. Most insurance groups will tend to keep bonds from the time they bought them right through to redemption. Insurers' future profitability, at least in part, depends on excess returns over their expected liabilities, meaning the money they receive they intend to invest to give them more than they have to pay out in insurance claims. But to get more of a return, insurers have to take more risk. But tighter regulations over the last 10 years means that more capital is being kept against higher risk positions. At some point, the balance moves against the firm's profitability, and then they have to stop taking more risks. Typically, this prompts insurers to hold government debt and high-grade corporate debt. These are bonds issued by blue-chip companies, the very areas where negative yields are most prevalent. This gradually erodes future profitability, reducing a natural capital building source for these companies. And this, of course, affects leverage and credit quality as well. For the banking industry, negative yields matter because the yield curves flatten out and invert. For banks borrowing at a deposit rate of, say, minus 0.5%, but lending longer, it's hard to make money. So profitability in the banking sector is hard to come by when the yield curve is flat or inverted. But despite these negatives, and this may surprise many, negative yields don't really impinge on investment decisions. There is little evidence that the yield gives you any clear indication of what returns you're likely to achieve over the next 12 or 24 months. Let us give you an example. If you purchased a little over a year ago a 100-year Austrian bond at par, they would now be worth 170 and 180, an average of a 75% return. You see, their interest rate then was yielding 2.1%, which today Austria has an interbank rate of minus 0.40%. In other words, buying those bonds then, a year or so ago, have given you an immense capital gain, because those bonds, albeit only yielding 2.1%, have become more attractive and therefore their price goes up. Now, admittedly, you have to sell them to release that gain. Now, if you are in an environment where you expect rates to continue to fall, those bonds you are already holding will go up in value and will decline only when it looks as if rates are due to rise again. Or perhaps too many people have purchased those bonds and they now become expensive. There's also another play to take into account. Now, this is more technical, and it's currency values. It is so technical, we're going to quote Luke Hickmore of Aberdeen Standard Investments, who perhaps has described this the easiest way that we've ever seen. So please bear with us. He's commenting upon negative yielding bonds, and we quote him now exactly. That doesn't mean that we shouldn't buy a euro-denominated negative yielding bond. By the time we've switched it back into sterling, we can add another 130 basis points a year. That's because of the way the foreign exchange markets work. If I buy 100 euros today, I convert my sterling to euros straight away to pay for that. At the same time, I will hedge the currency risk in 3 months' time, or do a forward foreign exchange transaction to sell euros back into sterling. That means I can lock in that forward 3-month foreign exchange today. Because of the current funding differential between sterling and euros, I can add an annualized 130 basis points to every position I buy in Europe. So I could buy a bond with a yield of minus 0.5% and still achieve a positive 0.8% yield in sterling, unquote. So you can have a negative yielding bond and yet still obtain a positive return or yield. Now, admittedly, that return is below inflation, but that is the yield. We must not forget any capital gain achieved as interest rates fall further. For these two reasons, capital gain and what we shall term currency arbitrage, not to mention, of course, a third being the security of government backing, these are the reasons the bond market has not entirely collapsed, even though so many have entered into negative yielding territory. And more may indeed follow. So we cannot write off bonds as an investment choice, and it would be wrong to assume that they will be. That said, the more negative the rates become, the more attractive those non-interest yielding safe assets become also, such as gold and to a lesser extent silver. Just imagine that all of the gold on earth ever mined, which is valued around $9 trillion, received an investment boost of just a couple of trillion from the current bond market. What would that do for the price of gold and the knock-on effect it will have for silver? The stock markets around the world are estimated to be valued at or around $69 trillion. Just imagine a 10% transfer to gold and the effect that would have on its price too. Now, we can hear you say, you're beginning to sound like a pumper. Perhaps not. The difference is we acknowledge the potential, but have our feet firmly on the ground as to the likelihood. Now, that said, what is true is that these alternate investments, whilst short-term, may still be attractive and serve as headwinds to gold and silver prices. In time, and when the alternative asset class bubbles begin to either burst or deflate, such as a stock market fall or crash, we shall see a transference of some degree to gold and silver. Perhaps not as much as we would like, as cash is still an alternative to enable investors to buy in again when the other assets deflate. Warren Buffett is a good example, who is currently holding $100 billion worth of cash. But even a small transference can have a profound effect on gold, silver, and other precious metals. And it is with this thought we leave you this glorious Sunday, not forgetting, of course, to ask you to subscribe to this channel if you haven't already done so. Thank you for listening. Do share your thoughts, and have a great what's left of our weekend, and a most prosperous week ahead. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.